The U.S. Federal Reserve is trying to keep the coronavirus crisis.
The unemployment rate rises to 14.7%. 20.5 million is the most historic job loss in a single month.
Is there any limit to the amount of money the Fed is willing to put into this economy?
In an historic, unprecedented move, the Federal Reserve to pump about $2.3 trillion into the economy.
From becoming an extended financial crisis, the coronavirus outbreak put the U.S. economy into a medically induced coma. As businesses across the country have shuttered and residents are urged to stay at home, entire industries are laying off or furloughing workers in droves. The sudden stop to business as usual has caused the U.S. Central Bank to act fast.
2 emergency rate cuts to 0, a bank reserve rate cut, swap line expansion, and then there's the whole list of asset purchases and liquidity facilities.
In total, the Fed could inject more than $11 trillion of liquidity into the financial and business system.
I think by the time all is said and done, you're going to see a Fed balance sheet that's somewhere in the $10 to $11 trillion range, which is pretty remarkable when you think that just a few months ago, the Fed was trying to reduce the size of the balance sheet.
After all, the Fed still has debts and assets left over from the last time it fought to keep the financial system alive back in 2008. What's liquidity, and why is it so important? Well, it's basically the lifeblood of any modern financial system. It's what keeps liquid assets, which are cash and anything that can be easily turned into cash, running through banks, to companies, and finally to your paychecks. Here's what the Federal Reserve has done to preserve a financial system rocked by a global pandemic. The Federal Reserve made a number of quick policy actions as the novel coronavirus began to take hold on the United States. First, with an emergency rate cut in early March. Then the Fed announced a slew of asset purchases, starting with an injection of $1.5 trillion in an effort to shore up short-term lending. That included billions and billions of dollars worth of purchases, including a lot of Treasury bonds, which is U.S. government debt. Days later, the Fed took even more drastic action.
Today, we reduced the target range for our policy interest rate by 1 percentage point, bringing it close to zero.
The central bank cut rates to nearly zero and announced a $700 billion quantitative easing program. This was made up of purchases of $500 billion of Treasury bonds and $200 billion of agency-backed mortgage securities, like from Fannie and Freddie. Slashing interest rates to near zero is one way to reignite economic activity. It encourages low-cost borrowing by both consumers and corporations. One way to think about interest rates is gravity. Iconic investor Warren Buffett often describes interest rates as having a gravitational effect on stocks.
Well, interest rates are like gravity in valuations. If interest rates are nothing, values can be almost infinite. If interest rates are extremely high, that's a huge gravitational pull on values.
Higher interest rates have a stronger gravitational pull on stocks and other asset prices, and pull their prices closer to zero. Lower interest rates? Well, that's like walking on the moon. The gravitational pull there is super weak. Astronauts in heavy spacesuits can lightlessly bound from crater to crater. It's the same with low interest rates and the economy. Taking out loans doesn't cost as much over time, whether it's to pay for a mortgage or massive corporate merger. And in Buffett's case, low interest means less gravity on stock prices, sending markets higher and higher. But keeping rates low has some downside. In fact, the US Fed and other central banks around the world had a hard time getting away from super low rates even as the economy boomed before the coronavirus pandemic. Some countries like Sweden and Japan even went into negative interest rates. In keeping with the whole gravity analogy, negatives are kind of like a black hole. They're hard to escape from. So with COVID-19 crippling the US economy, it could even be years until the Fed raises rates again.
They're not going to go up for 3 or 4 years. It's maybe we can't even afford to let them go up because of financial suppression and the debt that we're running.
Another risk of super low interest rates are higher debt levels.
If we start to get negative interest rates, that's not a good indication of where at least the bond market sees the economy going. The Fed has assiduously stated that they don't want to see negative interest rates, but they're going to have to guard against that.
Since rates have dropped to zero, the Fed doesn't want to pull the lever down further to negative rates, so it's gotten creative with monetary policy. the Fed relaunched a crisis-era facility that allows the large financial institutions like JP Morgan or Citigroup or Goldman Sachs to access short-term loans of up to 3 months. This is known as the Primary Dealer Credit Facility. After this announcement, the central bank tackled money market mutual fund liquidity. Basically, the Fed said it would make loans to banks to buy eligible high-quality assets from funds, so the funds have cash to give to investors that are selling assets. A few days later, the Fed expanded eligible assets to include certificates of deposit and municipal bonds. That same day, the Fed announced it would buy investment-grade corporate bonds issued by companies like Intel and Pepsi, as well as exchange-traded funds, also known as ETFs, of highly rated bonds. The Fed also said it would lend money directly to businesses, bypassing banks, with bridge loans of up to 4 years. And also on March 23rd, the Fed expanded its previous pledge. The central bank would now buy unlimited amounts of treasuries and mortgage-backed securities for as long as necessary. And the central bank announced it would start a Main Street lending program, but didn't share those details until weeks later on April 9th.
I've never seen anything like this announced in a single day. The Fed will buy up to $600 billion in loans through its Main Street lending facility. The Federal Reserve will offer 4-year loans. It will be open to companies with 10,000 or fewer workers and revenue of less than $2.5 billion. Note, principal and interest will be deferred on these loans for 1 year.
The last time the Fed offered such a direct lending program like this, it was 1934. But the Fed also announced even more market interventions. They will provide support for loans made to small businesses, as well as another measure that adds to existing credit facilities that will buy up business debt beyond investment grade and into fallen angel territory. That includes recently downgraded companies to junk bond status. And the Fed said it would loan directly to states and municipalities.
It will be offering, never done this before, up to $500 billion in loans to states and municipalities. That's right, the Federal Reserve will be financing municipal bonds or municipal notes.
These programs would total up to $2.3 trillion. The moves go beyond anything the Fed did during the financial crisis in 2008 and 2009, both in scope and in speed. The Fed first employed quantitative easing in the 2008 financial crisis. Quantitative easing is when the Fed buys a bunch of different bonds, mostly treasuries and mortgage-backed securities, and a lot of them. When the Fed does this, it's still helping push interest rates lower, but on a longer time horizon. Instead of influencing short-term rates, which is what the Fed does when you hear about cutting or hiking interest rates, these asset purchases allow the Fed to influence rates on 10 or 30-year government bonds by buying them on the open market. But what the Fed is doing this time around, it's a bit different than how the central bank responded in 2008.
The Fed, first of all, saying that it will purchase treasuries and mortgage-backed securities, quote, in the amount needed. Call that open-ended QE.
That's right. No limit on asset purchases. So it's essentially limitless QE.
When the Fed announced open-ended QE, that was the game changer as far as the market goes.
The purpose is to help ensure longer-term interest rates, like those for mortgages and car loans, remain low. That helps keep major purchases affordable for consumers and businesses. And then there's the repo operations. The Fed is offering almost unlimited support in the overnight lending markets, which is where banks go to fund their operations. Overnight markets are a critical piece of the financial markets plumbing. The Fed is offering nearly unlimited sums of short-term loans to 24 large financial institutions through repurchasing agreements. Essentially, when the central bank makes these moves, it's because it wants to maintain liquidity in financial markets. And in this context, liquidity basically refers to the amount of capital or cash at hand at America's big banks and financial institutions. Without enough liquidity, the whole system falls apart at the first hint of trouble. These big banks don't actually have all this money on their books to fulfill payroll for hundreds of companies or to offer loans for entities like small businesses. So banks participate in what we know as overnight markets, or repo markets, to lend each other money through short-term loans, back and forth forever, at whatever interest rate the Federal Reserve deems appropriate. The economic crisis caused by the coronavirus is vastly different than what we saw in 2008. This is a public health emergency. Past economic downturns happen because of big financial disruptions or market imbalances, like the housing bubble in 2008 and the banks caught on the wrong side of it. The way former Federal Reserve Chair Ben Bernanke described it, this downturn looks more like a natural disaster. In the 2008 recession, to him, that looked like a man-made event.
At the Fed, we're doing all we can to help shepherd the economy through this difficult time. When the spread of the virus is under control, businesses will reopen and people will come back to work. There is every reason to believe that the economic rebound, when it comes, can be robust.
Thanks to strict rules in place from the 2008 financial crisis, big banks have to carry much more capital on their books than they used to. They have to have more liquidity to cushion sudden economic shocks. And since 2008, the Federal Reserve and other financial regulators have learned how to step in quickly to ensure the credit markets function smoothly. What's also different this time around? The Fed has much less wiggle room when it comes to interest rates. Rates were already historically pretty low when the Fed began to cut them in 2019 and 2020. Before the coronavirus pandemic struck, the benchmark federal funds rate was at just 1.5%. In 2007, before the housing bubble burst, the federal funds rate was at 5.25%, so the Fed had a lot more room to cut. The hope is that super low interest rates can help small businesses in the long run, but many are still finding it hard to survive. The U.S. is also facing unprecedented unemployment numbers. All the job gains since the Great Recession have already been erased since the COVID-19 lockdowns took effect. Until the coronavirus outbreak is curbed from a public health standpoint, monetary policy can only do so much.
So they have pretty much just pulled out all of the stops to do what they can do. And of course, it's important to understand that there are certain things that are just beyond the Fed's limitations.
The advantage the Fed has is being able to take action without having to get approval from Congress. As of now, no policymakers or economists know how bad the coronavirus outbreak will continue to be, both for public health and the U.S. economy. Time will tell if the Fed's moves to support the flow of credit to the economy has been enough to cushion the downturn. Fed Chair Powell said more policy will be needed to keep the U.S. economy afloat.
I would just say we have a number of dimensions on which we can still provide support to the economy. As you know, our credit policies are not subject to a specific dollar limit. They can be expanded as appropriate, and we can do new ones. So we can continue to be part of the answer. Will there be a need to do more, though? I think the answer to that will be yes.
The Fed's monetary policy actions can't keep thousands of businesses from going under, and it can't steer the U.S. economy clear of a recession. But the central bank can hope to limit the damage and make decisions that will aid the eventual recovery of the economy.
Now, where can they go from here? There are a couple of avenues. Of course, the big enchilada would be the Fed going into actually buying stocks.
We're committed to using our full range of tools to support the economy in this challenging time. We're going to use them, as I mentioned, forcefully, proactively, and aggressively until we're confident that we're solidly on the road to recovery.
The Fed is going to institute what's called yield curve control, kind of trying to use its buying power in the Treasury market to target where it wants yields to be. So the practical effect of that would be to go out farther on the yield curve, to not just kind of buy the 2-year and the 5-year and the 7-year and even the 10-year. They would go out and start buying maybe 20 and 30-year bonds to try to drive down longer term interest rates.
And the Fed has made it clear that it won't let up on monetary policy.
I still think, we have a lot of economic pain that we're experiencing today, and that's likely to continue for some time.
Economists and investing professionals have differing views on the policy actions.
They have jumped in with both feet, and I think people decide whether it was right or wrong a year from now.
Some say the Federal Reserve is overreaching. Jeffrey Gundlach, founder of Double Line Capital and often called the Bond King, said the Fed is not complying with the Federal Reserve Act of 1913.
Pretty blatantly violating the Federal Reserve Act of 1913. I mean, the Federal Reserve cannot buy corporate bonds. Now, I know that they're not technically buying corporate bonds, but they're doing it clearly by sleight of hand and in a semantic sense not doing it, but they're certainly doing it.
Others say the Fed is taking the right steps to get ahead of the economic downturn.
You got to give them kudos. They moved effectively, they moved rapidly, they made decisions that were quite defensible, that were not inflected by politics.
When it comes to what's next, the Fed says it's going to monitor economic data coming in and act accordingly. That's Fed speak for Stay tuned.
Looking ahead, we're watching the data very carefully, using a lot of big data and other analytics, and not coming to any firm conclusions about how long this will last. And we're acting in every way we can and doing our utmost to support the economy, however this evolves over the next few months.
The Fed is doing what it has to do. We're in a kind of a crisis, sort of like a wartime situation.
They've got a lot of questions they've got to deal with. They've got a lot of issues that are going to last for years, and they better hope they can get it right.